Yeah, morning, Juliana, and thank you. I think that's absolutely right. If we look over the last 3 or 4 months, absolutely inflation concerns and then what central banks are having to do to manage those inflation risks has weighed on equity markets. I think the direct linkage is quite a simple one. It's just a discounting mechanism. So if you look at those higher growth, longer term secular themes that we have been very attracted to, clearly those are long duration assets. And so anytime interest rates are going higher and discount rate starts to become more significant, a bearing on the valuation of those names. So you've seen a little bit of retrenchment. But I think what's critical, and as we look forwards, is that we actually think the market has overreacted to some of those concerns. And our view at the moment is that innovation and some of those innovative areas of the market are now oversold. If we look at fundamentals, actually still pretty healthy. If we take since November, when those central bank cycles really started to become a lot more hawkish, what we've seen is that fundamentals have stayed pretty robust. Top line growth across technology, across some of the environmental solution providers, across some of the biotech businesses, actually still very healthy, if not improved versus 3 or 4 months ago. But valuations have declined materially. In some cases, we've seen 40 or 50% decline in prices against a backdrop of actually continued improved fundamentals.
I want to dive into the latest thematic research you've done on the innovation and as an investment theme. But just in terms of the latest data, clearly wage pressure is an issue. We got the non-farm payrolls report on Friday. We're not seeing the same wage pressure in Europe, but clearly it is a concern. How do you think about wage pressure and the increase in labor costs for companies moving forward? And to what extent will companies be able to continue passing on higher costs in the form of higher prices?
Yeah, look, wage inflation has, if we take the Fed's view of wage price inflation, has hit an all-time high. And so we're looking at the last couple of decades and saying, actually, we've got a very different scenario here that companies are having to deal with. Now, the reality is that leads to a lot greater selectivity in terms of how we're investing. Your point on pricing power and the ability to pass through those increased costs is absolutely crucial. And that's probably the core attribute of any investment we're making at this point in time. Now, the one thing I would say, however, as we tie this into some of the innovation, longer-term secular growth theme story, is that wage price inflation, which we'd expect to be fairly structural over the next few years, is actually also driving increased investment in technology. If it's automation technology to reduce the dependency on labor, or even if it's software investment to improve the efficiency of labor productivity, those are actually beneficiaries of a higher labor price environment.